Alright guys, so forgive my red eye today, just kind of woke up with this. But we must talk about the big threats flying from the G7 and flying from the rest of the world. And let's also do an update on the Iranian conflict because this has the risk of blowing up the entire global economy. Now this might seem superlative and that Sean has gone full fear monger again, but I really think the number of crises happening all at once is starting to crescendo. Now, first, let's talk about the West going after Chinese banks. It's not the first time. During the Biden administration, Yellen made a similar threat to Chinese banks. If you work too closely with the Russians, we'll punish you.
We continue. I stress that companies, including those in the PRC, must not provide material support for Russia's war, and that they will face significant consequences if they do. And I reinforce that any banks that facilitate significant transactions that channel military or dual-use goods to Russia's defense industrial base expose themselves to the risk of U.S. sanctions.
Well, that threat ultimately never happened, did it? Why? Because there's simply no way to cancel Chinese banks from the global economy. You can threaten sanctions, but it would ultimately backfire, won't it? Now, if China was an isolated island, then yes, cutting away their banking sector is a viable threat. But things have changed a lot over the past 2 decades. Now, in 2000, US trade totaled $2 trillion. That's almost 5 times the amount of China during that era. But once China entered the World Trade Organization and they opened up its markets, everything changed. By 2024, Chinese trade surpassed the US, hitting $6.2 trillion. In fact, the majority of the world trades more with Beijing than Washington. More than 120 countries buy and sell stuff with the Chinese economy in a massive way. And within that same framework of global trade, Chinese banks stand in the middle of everything. Now they give loans, they finance shipping, and they ensure payments are settled. Even if the US try to cut the banks away, the rest of the world will find a way to work with the Chinese. So you would think this strategy is horrendous and that it won't work. But what do you know? It seems that Europe, the EU, believes they can get away with it. Europe is trying to float a test balloon before they hit the entire Chinese financial system. They are drawing up plans to punish two small Chinese banks for trading with Russia. And under this new line of sanctions, EU financial institutions will be banned from any transactions with the Chinese banks. Now, does this sound like they are punishing China or are they punishing themselves? Now, this justification is both broad and bizarre. By processing transactions or providing export financing for trade operations. But yet, Europe is still buying commodities from Putin. Is that allowed under this new framework? So there's still a big sense of double standards that are far from being resolved. But make no mistake here, Europe will only be hurting themselves. Now we are seeing an EU that's desperate to help Ukraine, but oblivious to their own economic peril. The landscape today is even more threatening than the last 2 years. Now, firstly, the EU is still facing a 20% tariff hit when the reciprocal pause ends, and London just disrespected Europe again. They are going to be at the back end of the queue, which makes Europe's decision to slam Chinese banks really weird. If Brussels pisses off Beijing, how will it help their own situation? The actions of Europe seems to be one of pure desperation. Now, what is the definition of insanity again? It's doing the exact same thing and hoping it would work out for you. Now, these next three measures, if passed, are going to cripple Europe's economy. They want to cut away 20 banks from the SWIFT international payment system, plus imposing full transaction bans on them. Well, we can expect countries to move away from EU banks then. It would just backfire royally. And the next two measures are equally wild. The EU plans to lower the oil price cap from $60 to 45. Well, good luck to that. Russia will just divert shipments to the rest of the world. China and Asia will happily buy. In addition, the Commission is proposing to ban imports of oil products made from Russian crude. So China and India that process Russian crude into products they can't sell into the EU. Now, do you see how badly this will end? Europe is very, very desperate to cut away all vital supply of energy during a trade war. The problem is Europe's manufacturing economy. Total exports fell by almost 2% year on year in April. Now imagine the damage done once the tariff rate doubles from 10 to 20%. The data really shows us how fragile Europe's exports are to countries with a competitive export market. Europe's energy sanctions is just going to drive the economy deeper into the ground. Now, the EU still recorded a 3.8% export growth with the US, but that number will be under tremendous pressure in May and June. The euro is strengthening, and US tariffs will be making their exports even more unattractive. However, look at its trading relations with China. EU exports to the Chinese economy have collapsed by nearly 16%. They are selling less because their products are just not competitive. EU supply chains are just too expensive, they are just too fractured. Meanwhile, their import growth from China rose by 8.4%. As a result, their trade deficit with the Chinese grew by over 7 billion euros. Now, this dynamic really underscores how the EU has very few cards left. Maybe they have no cards left. Whatever products they are selling to the US is being powered and being fueled by affordable Chinese imports. Now, China, of course, is slamming the plan. They call it a unilateral sanction because it's essentially what it is. There's no sugarcoating things. But beware the blowback effects. China is not going to sit idle and just let Europe steamroll over their banks. Hong Kong, which is part of China, is moving to create a rival to Europe's Euroclear system. Now, this is significant because the idea is to boost the global use of the Chinese RMB, and this will allow China to strengthen their system and to safeguard global assets and help promote the use of their own local currency. And if Europe targets Chinese banks, how safe are Beijing's assets in the EU banking system? Now, better to get out now and create your own infrastructure. Now that the cat is out of the bag, there's no U-turn for this Euroclear rival. Now we know China has been shunning the US economy and the dollar, but if they choose to shun the euro, especially in trade settlements, this poses an even bigger problem. Less countries, companies, and investors will use the euro, and this will drive down the demand for euro assets. EU bonds might become the next investment pariah, especially as the EU economy starts to stagnate. Now, for decades, the euro was the second most popular reserve asset, while gold has now officially surpassed it. It is now 20% of total central bank reserves. The dollar has slid down to just 46%, but look at euro assets. It stands at just 16% today. And this should be a serious wake up call to the Europeans. They have done too much damage to their own financial system and the economy. Now, first was the sanctions on Russian oil, then came the asset confiscations, and now they want to threaten China. If this craziness continues, we can expect the world to not just de-dollarize but de-euronize as well. While Europe struggles to find back their common sense, we have to touch a bit on the Middle East war. Israel and Iran, they're escalating like never before. Iran has been firing hundreds of missiles into Israel, with some hitting the target. And as if things can't get worse, Israel has gone beyond just nuclear sites. Israel has struck Iran's refinery in the world's largest gas field. So 12 million cubic meters of production has been curtailed. In other words, a supply crunch. And here's how dangerous this can evolve. If your oil and gas fields are destroyed, Iran will have no qualms about cutting off regional supply to the world to make a point. And the US seems to be fully on the side of Israel and pressuring Iran to cave. Well, this might not happen. In fact, the exact opposite could occur. Iran might not cave. They are threatening to close the Strait of Hormuz, the vital lane that separates the Persian Gulf from the Arabian Sea. And the risk is clearly more than just ordinary shipping. We are talking about a full-blown energy crisis that can push the world into recession. As mentioned earlier, 11% of the world's seaborne trade goes through this small choke point, but it's the global energy complex that is in real trouble. High inflation amid a tariff war is unthinkable. And let's quantify how serious this risk is. 20% of the world's global oil consumption flows through this strait. So if it does close down for whatever reason, it's game over for the world economy. Now, some countries will be more affected than others because of their access to energy. The US and China are insulated from energy shortages. America has shale oil, China has Russian supply. But energy prices for them will still rise because oil is a global market. The direct response will be higher prices across the board. energy companies will ship their cargo to regions offering top dollar for the oil cargoes. And the problem is that there are simply no alternatives to get the oil out. Iran and their proxies are in full control of the supply routes if they really want to do it. Now, on the right chart, we can see how precarious the situation is. Should the strait be closed, there are not enough pipelines to swing crude flows to the west. Even if that's possible, getting oil flowing to the Suez Canal will have to go through the Red Sea, and we know what happened over the past few months. Ships today are being warned about going through the Red Sea. In a full scale conflict, both the Persian Gulf and Red Sea could all be shut down. And there's a reason why oil prices are exploding. Brent is almost at $75 because all the talk of supply increases lately, guess where they were from? They were from OPEC, and the majority of them are within the Middle East. For other energy markets, it's also an unmitigated disaster. Now, 20% of global LNG trade also flows through the strait, much of which are shipments from Qatar, the gas giant there. Which countries are the most reliant on gas? Now, which regions in the world import the majority of their energy needs? It's Europe and Japan. Now we have major spillovers into manufacturing economies. The auto sector there is going to get clobbered. All the Volkswagen and all the Hondas or the Toyotas made domestically will cost more just from power costs alone. So when markets open tomorrow, boy, can we expect red all over the screen. The only things flashing green would be oil and gold. The world economy is about to take a big hit. Now, recap on the situation shows how horrifying things can get. Markets aren't pricing in this just yet. Iran's South Pass gas field has been struck and production is down by 12 million cubic meters, as we said earlier. Oil depots has also been lit up. Oil fields in western Tehran are on fire. Multiple refineries are also on fire. And this is putting immense pressure on 3.5% of the world's global supply. Now, most of Iran's energy exports are flowing to China, and we'll see the Chinese start flooding other suppliers with buy orders. So, prices across the board will be flying up. There's no escaping this one. Over the past few weeks, we have heard Trump and Biden claim that US inflation is also under control, but many analysts are pointing to a big rebound later in July and August. In Q3 this year, we can expect headline CPI to rise and hit 4%, and this will linger until summer 2026. The lag effect is coming and high prices will be hitting a shelf near you. But this estimate was before the Israel Iran escalation. Now, imagine what a $75 or $80 or $100 crude can do to prices across the board. This has the potential to spike prices in Q3 and Q4 even higher and cause US consumption to slump. Short term inflation that will cause a big deflation hit for the overall economy. So we have to brace for impact. The risks are starting to build like never before, and a new inflation crisis is building really, really fast. But as always, let me know what you think. Will Europe really sanction Chinese banks? And will Iran really shut off the strait? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these insane times.